So Europe, it tends to trade at a 15% discount to the US historically. Right now we're at a record 35-40% discount to the US. So it is
15 historically.
Yes.
I get that for all kinds of reasons.
Yep.
Now as much as 40.
Exactly. And I think usually the retort that we'll get is that, well, of course, Europe doesn't have the growth that the US does, so that's why it trades at a discount. But it's both the value parts of the market and the growth parts of the market that trade at a discount to the US. So it is everything contributing. I think it's difficult. Obviously, we've been in a macro environment of low inflation, low rates that have made it difficult for European companies to earn at the same level as US peers. But going forward, I think it's possible to envision a world where the macro environment has a better sort of setup for European companies.
I understand to a certain extent, David, why Europe trades at a discount for many reasons that experts such as yourself have explained to me over the years. But I don't understand why big international TNCs, I don't know if we still call them TNCs, transnational corporations, which are trading in the same markets as the US on a global basis, that have this huge operations in the US and elsewhere in Asia, Middle East, why they trade at such a discount when they are very similar companies for all intents and purposes.
Yeah, and I think it's difficult. It might just be the fact that there is not as many inflows generally coming into Europe, and that's something that we've seen historically, is that Europe-only equity funds have basically seen consistent outflows for the past decade or so.
Oh, thank goodness, it was just the UK.
Yeah. So the money that's coming in is really when investors decide to put money into sort of global equity funds. It's really US versus ex-US now, and that decision is what really matters for Europe.
Had a, I think, fascinating interview at the start of the show with Roy Jacobs, a man I really enjoy speaking to, the boss of Philips as well. And just to recap to our viewers, in the second quarter, in the July numbers when I spoke to him, they had a 2% growth rate, comparable sales growth. Because of China, they've now had a negative 2% in the third quarter. For me, even though they're looking flat over the year, that looks a dramatic decline as well. Yeah. How worried should I be for ownership of any corporates about what's going on in China?
Yeah, I think it's absolutely critical to the European market. Of all the major markets in the world, Europe is probably first or second most sensitive, maybe Australia a little bit more. But something that we've seen inside of the European market, we kind of track these China proxies that are there. And for the Stock 600 as a whole, earnings have been downgraded about 2% this year. For China proxies within the Stock 600, earnings are down 10%. So it's 5x that size of earnings downgrades. And in terms of multiple derating, also is more significant in the China proxies.
That's really interesting, because if I want to go best in class, that should give me a degree of insulation. But you're pointing out, I think LVMH is probably best in class. It's certainly there or thereabouts as well. And that is a great example of what you just explained to me, about the China focus, even though it's a company which is, it's a brilliant company.
Yeah, it's super high quality companies that you can find in Europe, but precisely this, China is just a key headwind. But I think going forward, what's interesting is you need to think about this balance of risks and where we're at. And really, if these China proxies have derated more than the overall market, if earnings have been so severely to the downside, just this change in the China narrative, the change in the China policy story, potentially there is some upside there. So we do like European Lux goods, for instance, in our European sector.